This indicator can increase your profit. To add it to your chart, here you click on Indicators and search Adaptive Volatility Scaled Oscillator. This one, which is a new indicator from Zierman. Alright, this is the indicator, and as you can see, it is added here below the chart. It's actually an oscillator, and you can see that we have a line and a histogram that are moving above and below the center line, which is 0. This indicator is a volatility indicator, but not an ordinary volatility indicators that you know by scaling different metrics from volume, price changes, standard deviation, ATR, and Yang volatility, and also applying adaptive smoothing method. It helps you to identify market conditions where volatility is significantly high or low from normal. It uses Z-score technique to standardize the scalings, so it will be able to show significant high or low volatility relevant to recent data. Here in the settings of the indicator, here for volatility measure, you can choose your desired measure for volatility. I continue with standard deviation because it's a better choice for the strategy that I'm going to explain, and it will better match with the other indicator that I'm going to add. So depending on your trading strategy and other indicators on your trading strategy, maybe another type is suitable for you, which by a little trying and testing, you can choose the proper one. The interpretation and use of the indicator will be the same. Alright, this histogram is showing us the measure of the volatility in the market. When it is above the center line and positive, it shows above the average volatility, and when it is below the center line and negative, it shows below the average volatility. We have also a line here, which is an adaptive exponential moving average of the Z-score. It is a smoother and less responsive to volatility change, so it will be a good choice if you just need to track above the average or below the average volatility. Please pay attention that here the indicator is telling us about high volatility or low volatility, and it is not telling us anything about direction. If the histogram is above the center line, it tells us that we have above the average volatility, and this increased volatility can be either for decline of the price or advancing of the price. And when the histogram is below the center line, it tells us that we have below the average volatility, which this decreased volatility can be because of a pullback or flat market. The indicator has marked -2 and 2 levels for helping us to know when we have significant high or low volatility in the market. When the histogram is above 2, it shows that we have significant volatility in the market, which is much higher than the average, and this can be a signal for a breakout. On the other hand, when the histogram goes below -2, like for example here, it shows a very low volatility condition in the market, which usually happens before a breakout or reversal. This will effectively help you to identify flat market. For example here, you can see that it was below -2, telling us that we are in a very low volatility condition in the market, and after that the histogram is just in the middle range. And also when you check the price action, you can clearly see that the price is moving flat, and there is a potential for breakout, which happened here, and you can see that the histogram also went above 2, which shows high level of volatility in the market. So when the histogram goes below -2, it shows very low volatility and probability of range market, so a breakout is expected to happen, which in that case happens with a sudden increased volatility, which is shown by this indicator when the histogram passes 2. Please pay attention that this low volatility condition is not always for a range market, and during pullbacks we have also very low volatility, which in this case this is just a very short-term flat market. This indicator can be used in trend following strategy and breakout strategy. In trend following strategies, it helps you to identify non-trending market, so you stop trading until a new trend is established in the market, or it can also help you with low volatility periods in the pullbacks and then entering a trade when the volatility goes back above the average. This indicator is also a perfect choice for breakout trading strategies because it can help you with identifying low volatility periods in the market, which gives the possibility of a potential breakout, and then it helps you with identifying the breakout because it can show you the spike in the volatility. In this video, I'm going to teach you a breakout trading strategy based on this indicator, so stay tuned and let's get started. Here we click on indicators and we search from a channel, this one, which is written by Big Beluga. This is a very powerful indicator that is built based on fractal adaptive adaptive moving average to create a dynamic channel around the price. By the help of this channel around the price, it can adapt its sensitivity based on market volatility. First, here for the indicator, we click on these three dots, and then here for visual order, we click on bring to front. So the candles will be colored based on their position regarding the channel. Basically, when the price crosses above the upper band or lower band, it gives the possibility that a change in the price direction may happen. And when the price remains inside the band, it shows a very low momentum in the market, and so possibility of flat market. In this situation, the candles are gray. When the price crosses below the lower band, it shows increased downside momentum and the candles become blue. And on the other hand, when the price crosses above the upper band, it shows increased upside momentum and the candles become green. So you can see that this indicator can also help us with flat market, where there is a low level of momentum and volatility in the market. And it can also help us with trending phase of the market when we have increased momentum. I have a complete guide to this indicator. The link is also placed in the description, and I highly recommend you to watch it so you learn how you can effectively interpret this indicator. Alright, now in this setup, we want to mix the signals of these two indicators to exactly know when we have a break out of flat market. This is how we do it. As I said, when this indicator crosses below the lower band and become blue, it is a bearish signal showing that we have increased downside momentum. And in this indicator, when bar of the histogram is closed above 2, it shows beginning of high volatility in the market. So when we have both of these signals at the same time, it is a significant signal that the price is going to decline, so we enter a short position. At this point, you can see that this indicator became blue, and at the same time, this bar of the histogram is closed above 2. So the sell signal is confirmed, and we can enter a short position at this point when this new candle is opened. The stop loss for this trade is placed above the middle line of this indicator, and profit target at 1.5 risk to reward ratio. Moving back on the chart, for finding trading opportunities, we look at this indicator to see when the histogram is closed above 2. At this point, you can see that these bars are closed above 2, but we don't have any signal from this indicator. So this signal here is rejected. Moving back on the chart, here at this point, this indicator became green, and at the same time, the histogram is closed above 2. So the buy signal is confirmed, and we can enter a long position at this point when this new candle is opened. The stop loss below the middle line of this indicator, and the profit target at 1.5 risk to reward ratio. Moving back on the chart, at this point this indicator turned blue, and at the same time in this indicator the bar is closed above 2, so the sell signal is confirmed, and we can enter a short position at this point when this new candle is opened. The stop loss above the middle line of this indicator, and profit target at 1.5 risk to reward ratio. Please pay attention that although this trading strategy is very accurate, because from one side we have signal of increased momentum after a period of flat market, and on the other side we have a signal of very high volatility in the market resulting in high probability trading opportunities, but this doesn't mean you will not encounter false signals. No trading strategy is capable of this, and losing positions are always part of the game, so you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that you can use. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a successful trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.